Okay. Hi, everyone. Um, Welcome to my Q1 2024 quarterly performance update. Um, I'll go through the usual disclaimers and everything before we start, but generally speaking, questions, if you could try and leave them towards the end. If you're going to be leaving before that and you really want to ask it, then feel free to throw it in the chat and I'll try and go through them when I get to the end of the presentation. First things first, the disclaimers. This is marketing communication. I do not understand your personal circumstances, so this should not be taken as financial advice. The views that I share here represent my own opinions and not that of eToro or anyone else. Please obviously do your own due diligence and research before you make any investment decisions. And of course, if you are investing, then your capital is at risk. Okay, so the way this usually works, I'll go through the introduction, talk about myself a bit, talk about the strategy of my portfolio. I'll go through my performance for the quarter and some of the markets and benchmarks and how I compare. I'll discuss what happened during the quarter in terms of both the markets and big events that were driving markets, as well as in my portfolio itself, some of the portfolio highlights. And then towards the end, I'll talk a bit about kind of future outlook, and then at the end we'll have a Q&A. I should also say, just before we start, that if you're unable to continue watching the whole thing or whatever, this will be available on YouTube from tomorrow for anyone who missed it watching this live. So if you're watching on YouTube, hi, please don't ask questions because they won't get answered there. If you do have questions, then you can always ask them on the eToro newsfeed to me. Okay, first things first. I finally took a new picture of my desk. I still haven't updated the picture of me, so maybe I'll put maybe next time I can get that refreshed as well instead of me and Yoni there. But yes, a bit about me. I have over 13 years of experience now in investing. Initially, I was self-taught for a long time up until a few years ago, where I got some qualifications with CISI. My CAGR since joining, or my annualized total return on eToro is over 31%. I pride myself on running a portfolio that's quite ethical. I try to vet all of my investments for their impact on kind of social situations, society generally, and on the environment. So I use ESG criteria and various other things to do that. And really my portfolio is kind of based around disruptive technology and disruption generally. So it can be disruptive business models or, new technologies that are kind of innovating and pushing in new directions. Sometimes that can be, the investments can be in fields that are being disrupted as well. So it's not necessarily that I always invest in the company doing the disruption. Sometimes I can invest in other companies that will benefit or even lose out in some way. My background before I started on eToro, which now is almost 8 years ago that I went full-time on eToro as a popular investor. My background is in gaming and events. So I used to run big esports events around the world. I was a professional gamer before that. So a bit of a strange career move to move into investing, but I feel like there's quite a lot of overlap in the strategy involved and the kind of quick thinking that's required. I've been a popular investor since 2016, but I went full-time in 2017, as it says there. So yeah, it's been a long time, and I just celebrated 10 years on eToro as well. So there's a post on my newsfeed if you want to read about that. I share a few kind of insights into my journey through eToro over those 10 years. A bit about my track record. So as I mentioned, total annualized return is 31.55%. My assets under copy is around $60 million as of the end of that quarter. I had over 14,500 copiers, and my total lifetime return on eToro, if you had copied me from day one, you would have made a profit of 1,561%, give or take. So pretty healthy profits, I would say. if I do say so myself. Strategy-wise, as mentioned, disruption is really what I try to look at. So first of all, identifying a future trend is the first thing I always try and do. That can be things like electric cars, it could be cryptocurrency, it could be that a lot of people are moving from one country to another, it can be political things, war, everything in between, new products and services that are coming out in the world and how people are adopting those. Once I've discovered a kind of trend that I've identified, I then try and find products and services that are likely to benefit from that trend. I spend a lot of time focusing on those products and services in quite granular detail compared to most people, I think. So if you ask me about my investments in solar companies, I'll be able to tell you different models of inverters that they sell and how they work, and even possibly to some extent how to commission them, which is a bit unnecessary. But that's the kind of depth that I like to try and put into the research of these things and understanding the products, because I think if you understand the product, then you've got a significant advantage over other investors, because you know what's more likely to be adopted and which features people are likely to value. Of course, after that, I look at the fundamentals, so the balance sheet, cash flow statement, and obviously all of the earnings reports. I go through, I listen to earnings calls for almost all of my companies each quarter, and take down notes. And yeah, that's kind of the boring bit, but the numbers are fundamentally what matters and what drives growth in the investment that we're kind of investing in. I then vet everything for ESG criteria. So I avoid fossil fuels, I avoid weapons, I avoid drugs and alcohol, gambling. All of those things are avoided in my portfolio. I also try very hard to give a positive tilt on the portfolio in terms of looking at what they're doing in terms of societal impact and environmental impact. So I specifically try and find companies that are actually making genuine progress towards improving the world in some way. That's not always the case. Sometimes some of the things in my portfolio are a bit more average, I guess, but really the goal is not to have a negative impact with the portfolio. Portfolio fit. Yeah, more fun stuff. Portfolio fit. So this is obviously making sure that whatever it is that I'm investing in is going to fit into the portfolio in a sensible way. It's not going to leave me overexposed to one specific area in a way that is likely to cause dramatic underperformance. Of course, that comes with the flip side of you lose out on some of the dramatic overperformance potential as well. So you won't see me with 20% of my money in crypto. You're very unlikely to ever see me with more than 10% of my money in any single investment. I think Microsoft is just above that at the moment, but that's the only one. Next up is sentiment. So really, this isn't something I pay too much attention to, but it's more so kind of looking at how both investors and customers and clients for those businesses feel about that industry and that business, and trying to kind of gauge the current direction of things. That's mostly useful for kind of deciding if it's a good entry or exit point into various investments. And then finally, there's technical analysis, which is essentially the same thing really, but via a chart. So looking at the charts for the investments that I'm in and using that to determine whether or not it's a good entry or exit point, if I should be adding exposure or potentially decreasing exposure to something. So going into Q1, portfolio themes remained the same as last quarter. I updated some of the pictures because it gets boring if you always have the same picture. So semiconductors, got AMD pictured here with their latest SoCs that they released, obviously AI focused for the most part, and machine learning. Technology is obviously a much more broad kind of area than semiconductors. So I've got Salesforce as the example here, but CrowdStrike, which is listed in AI, could also be considered technology. I've got companies like Garmin, which make more kind of physical products and things, as well as some of the services that they offer. So yeah, it's quite a broad category, but technology is obviously a big part of the portfolio. Renewables is another large part of the portfolio, a little bit less so in the past year or so, because of how much the solar and wind industry have struggled given the higher interest rates. But I still have a lot of exposure to Enphase, SolarEdge, and a couple of other companies that are a bit smaller position-wise in my portfolio. AI obviously is the kind of hyped thing at the moment. I've got Nvidia in the portfolio as one of my biggest positions. Microsoft is the biggest position I hold. Salesforce, as mentioned, there is another company that's doing a lot in AI. Adobe. There's quite a few in the portfolio that are kind of doing interesting things in the AI space and have good exposure to that. Next up is something a bit more kind of ordinary, I guess, which is buildings and materials. I say buildings because really this kind of includes some sort of infrastructure stuff and other kind of more industrial companies in some ways. So the company I've got pictured here is Rockwool, but I also invest in things like a copper mining company and a couple of lumber companies as well. So yeah, those would all be included in this category. And then last up is the electrification trend. So Encore Wire is what I've got pictured here, but there's several others as well. Actually, Encore just got buyout offer from another company that I'm invested in. So that's why I actually used this picture last time, but I felt like I should keep it there because it's the last time I'm going to get to use it. So because they're likely going to be closing out, being acquired by Prismian Group. So those are the themes going into Q1. I'll take a look at performance now. So as you can see, we outperformed everything except the Stocks 50 in Europe. And realistically, I would say that we can count that one as a draw. Pretty happy with this. It's not quite as much more ahead as I was last quarter. Last quarter, I outperformed by a healthier margin. But this quarter, I'm still outperforming, which is good, trying to make up for some of the lost ground after a few poor quarters last year in terms of performance. I should stress that this is outperformance despite the fact that I do still have exposure to those solar companies, which did again have a pretty poor quarter. Likewise, I also still have exposure to quite a few small caps. I'll talk about that a little bit later in the presentation, but you can see here from the Russell 2000 that small caps didn't have a great time again. I think largely that's due to the fact that the much awaited interest rate cuts are still around the corner. They've been around the corner for, it feels like 6 months potentially. And I think realistically, we're still going to have maybe another couple of meetings before, 1 or 2 meetings before we start seeing rate cuts coming in. But when that does happen, we'll be in a position where some of those smaller companies that we have will benefit from the lower interest rates. The other thing that I'd mention here, as well as obviously, again, like last quarter, Europe had a really strong period. You can see that the Stocks 50 and the DAX 30 actually respectively outperformed the S&P 500 and the NASDAQ 100. Obviously, they're much smaller indices, so there's more potential for kind of weighting biases and things to come in potentially. But either way, still good news for Europe. Trailing 12 months, 15.22%. So you can see that's still very far behind the NASDAQ and the S&P 500, but it is catching up with them. Again, that's because 3 and 4 quarters ago, my performance was much weaker than those indices. So it was starting pretty far behind, but as we're kind of rolling through and as this updates next quarter, hopefully we'll see my number come much more in line with the S&P 500 and the NASDAQ 100 as the two kind of primary benchmarks that I want to try and be ahead of. Of course, that said, it is worth considering that unlike the S&P 500 and the NASDAQ 100, this is a more ethically run portfolio. So, you can make the argument that it would be difficult to perform them, given more limitations on what I'm allowed to hold in the portfolio. But regardless, that's still my target. So I'm not trying to make excuses. I would still like to very much beat those benchmarks. And yeah, most years I've managed to do that, but last year was not one of them. So hopefully this year I can get ahead of them. Okay, so looking at Q1 market highlights, the things that kind of drove the markets. I mentioned this actually in my future outlook for the past, I think, two of my quarterly updates. I said that EVs were looking a lot weaker, and sure enough, Rivian, Tesla, whoever you look at really in the EV market, pretty much all of them have been having a bad time. Really, I think that's partially down to interest rates. A lot of people buy their vehicles on finance, so obviously that's going to make an impact. Um, Increasing costs as well due to inflation in terms of producing the vehicles and that then pricing people out of it. The fact that people are feeling poorer, so they don't necessarily want to be buying new vehicles at the moment, and EVs are typically more expensive than gasoline cars. So yeah, there's quite a few things that are kind of driving this trend. I do think that it will kind of swing back around in favor of EVs at some point. Probably in the, I would say probably not really until the start of next year. But you know, that's a trend that I identified and managed to avoid. So pretty happy that I didn't really have any exposure to that over the past couple of quarters. Israel, Palestine. Obviously, there's been lots of tensions in that part of the world. I mean, the one next to it as well. Looking at what's been going on in the Gulf of Aden, impacting shipping. Obviously, Iran has been involved. We've still got the conflict over in Ukraine that's going on. So, you know, there's a lot of these kind of things that are still impacting markets at the moment, and a lot of fear in markets, especially through this quarter when all of these things were kind of erupting. I think realistically, it's a situation we're going to have to continue to keep an eye on. You know, around that entire region, and not to mention even China as well. So yeah, it's definitely been driving markets quite a lot. We saw oil prices spike at various points. OPEC is still trying to limit supply of oil more to prop up the price of barrel of oil as well. So all of these things have impacts on markets generally. So you've got to be a bit of a kind of political nerd as well when you're trying to look at investing. Bitcoin pushed to new highs. Obviously, the halving's coming up. There was obviously the ETF was approved quite a while back now, and so that led to a pretty strong rally in Bitcoin, and some of the other cryptos have followed it up as well. Ethereum's ETF obviously is the next thing that people are looking at. I think realistically, when you look at how these halving cycles tend to work, it's usually a sell the news moment when the halving actually occurs. So I would say that possibly we've seen as much as we're going to see for crypto for the next few months at least. It may end up kind of climbing higher again towards the end of the year, especially if interest rates change. That could also impact things. But generally speaking, I think there's better opportunities out there in the markets than investing in Bitcoin at the moment or in cryptos. Bitcoin itself actually is something that I wouldn't invest in anyway because I think the environmental impact is too significant. But Ethereum and some of the other cryptocurrencies I would invest in, and do hold in my portfolio at the moment. Ukraine struggling against Russia. Again, it feels like this is almost more of a geopolitical slide than it is a market slide, but all of these things are obviously having quite substantial impacts on the market. Yeah, Ukraine has been on the back foot. We just saw, I think 2 days ago, the US Senate passing the $95 billion of funding for Israel and Ukraine, 60 billion of that going to Ukraine. So that hopefully will kind of help stabilize that region a little bit more. Ukraine is obviously very, very important in terms of a lot of raw materials and a lot of grains as well. So things like sunflower seeds and things are very very large crops that are kind of based around Ukraine. There's also a lot of metals and things like that come from the region. So it's strategically for Europe and for the West generally, it's quite an important location. So yes, that's another area to be watching because that then can obviously lead to some kind of commodity price fluctuations as well, depending on how things unfold in that region. Lastly, we have rate cuts later than expected. So I think if you had asked everyone 6 months ago when rate cuts were likely to come in from the central banks, they would probably have said, late Q1, early Q2. Realistically, it's now looking like late Q2, early Q3, maybe. The Bank of England and the Fed probably the two that are likely to blink first. Largely because they've got the highest interest rates, but also I think the US economy tends to be, I would say overall looks the strongest at the moment. So I would expect them to move most quickly on this. Some portfolio highlights, starting with NVIDIA. I try to avoid covering NVIDIA to some extent because of the fact that it feels like the company that everyone is talking about, and I prefer to highlight some of the lesser known things usually in these sorts of presentations. But there really is no avoiding it this time. It was 40% up almost. I think it was about 35% actually, ahead of their Q4 earnings in February, I think it was. They produced fantastic earnings again and exploded even higher. In the past, I was looking at it the other day, their financials, and their revenue has grown by something in the region of 300% in 1 year, which is really quite staggering, and just goes to show the kind of demand that there is for AI chips. Where NVIDIA obviously has a significant advantage at the moment. NVIDIA is one of the biggest positions in my portfolio, so obviously this is great news, and it will remain one of the biggest positions in my portfolio for some time. I actually first invested in NVIDIA about a decade ago. It's one of the first companies I ever bought. Had I held on to it, I would possibly be richer than I am now if I'd have just kept all of my money in NVIDIA, but that's not the way things go. We like to diversify. Small cap sync. So I mentioned earlier about the Russell 2000 struggling a little bit compared to some of the other indices, which is not actually that unusual, to be honest. But I wanted to highlight this really as a way of kind of pointing to some of the companies in my portfolio that are struggling, that I'm still kind of just holding on to these small positions of, because I still believe fundamentally in those businesses. So Lovesac is one that's pictured here. They had their earnings quite recently, and I would say that overall it looked pretty okay. These kind of businesses don't have the kind of capital buffer that we see for some of the much larger companies, so they are much more at risk of financial trouble if things do go wrong. But with all of these, I'm still really quite confident in the markets that they're serving and their position within those markets. So I think once we see the economy recover a bit more and interest rates come down, we should see these companies benefit. Next up is electricals stay strong. I mentioned this in my last quarterly update as well. This is probably the trend that I'm most proud of identifying, honestly, because I think people look at companies like Eaton or ABB or Schneider and think that they are quite boring companies that are only going to grow at 5% a year, and that's why they pay dividends, and there's not too much excitement there. But I wrote a post, I think last month, about Eaton specifically, highlighting that they are benefiting dramatically from the investment into AI, because they produce a lot of the equipment that's used in data centers, the kind of supporting equipment, whether that be cooling systems or systems in terms of power management and other similar infrastructure. Even some of the networking equipment is made by some of these guys. So all of these companies have done really, really well, way above the benchmark. As you can see, there's quite a few in my portfolio: Eaton, Encore Wire, Schneider Electric, Prysmian Group, and ABB. All 5 of those were above the S&P 500 and the NASDAQ, respectively, the same as they were last quarter. And yeah, I'm really, really happy with the performance of all of these businesses. So I'm still hopeful that there's quite a lot of room left to grow as well, as we kind of look at things like smart grids and some of the kind of load balancing technologies that will be needed through the electrification trends. But I'm really, really happy with how that part of my portfolio has been performing. Finally, I wanted to highlight another company that has been really just doing well for the past, well, ever since I invested in them, actually. So the past 3 years or so that I've been invested, Train Technologies have been just solidly outperforming the benchmarks, um, roughly growing around 30% or so, 20 to 30% a year. Um, they produce ventilation systems and HVAC systems, among a few other things as well. And actually, they are one of the most sustainable companies in my portfolio as well. I think they've won numerous awards for being like the most green company that exists and things like that. Obviously the people who give these awards, who knows what their criteria is, but regardless, they've been performing really well. As you can see here, up 23.3% in Q1 alone. So incredibly happy with that. They also just had their earnings not too long ago. I think it's a position that I'll continue to hold in the portfolio. Only a mid-sized position in the portfolio, I think, is around 2% or so, but they've been doing well for me. So I just wanted to highlight it because I never really talk about them too much. So thought I'd include them here. Taking a look forward at outlook. So this is the outlook that I gave in the last update, and the reason that I include that is that you can kind of judge if I was correct or not. So yeah, I said that the soft landing and the interest rates and things for the US should be coming pretty soon. I think realistically, I was a bit too optimistic on that, and it's probably going to be pushed back a small amount. But generally, that's still something that I'm looking out for. You'll see that on the next slide. The electrification trend that I mentioned before slowed down. Quite a lot of backlash from that. Obviously, gas and oil prices also have an impact on the need to electrify things and on EVs especially. So yeah, I think this one played out, and I'm kind of happy that I predicted that one okay. Last up was the recession risk, potentially dampening market performance. I thought that the EU and UK would be weaker than they are. The UK I still think is not in a fantastic position, but the EU industrial companies especially seem to have picked up a bit more recently. They have a lot of exposure to automobiles and things like that, which again is a little bit weaker at the moment because of interest rates. And they're obviously very capital intensive businesses, especially as they're transitioning to electric vehicles. So I still think while maybe the recession risk isn't there, I still think that there's some caution required when looking at companies to invest in Europe. But generally, I'm kind of okay with how things are panning out there. It looks like it's not quite as bad as I thought it could be. So looking ahead now that I've adjusted my kind of 3 key things that I'm looking at, I think elections has found its way back onto the list here at the bottom. The US and UK elections, probably 2 of the more important ones. I also mentioned Taiwan in this. They had their elections earlier this year. Which was quite an important one. And India are currently in the process of their kind of week-long election cycle right now. It looks pretty likely that Modi will remain in power, which is probably a good thing for markets, I would say, overall. He's kind of been there while markets have done well in India. So and India is also set to become, I think, the 3rd largest economy globally by 2030 or 2028 or something like that. So, that's kind of still quite an important election. Above that, we have global tensions. I think realistically, we thought things were kind of not great, 3 months ago, 6 months ago, with everything that's been going on with Russia and Ukraine, but there have been a lot more tensions in the Middle East region around Israel, Iran getting involved as well more recently, and then obviously you've got the situation down near Eritrea and Djibouti and everywhere around there, and Yemen. That's causing a lot of disruption to shipping, which is somewhat linked to what's going on further up towards the kind of top of Africa. But there's a lot of tension globally at the moment, and I think this is actually one of the biggest risk factors. I wrote a post quite a long time ago about how to kind of manage risk around investing in semiconductors, given Taiwan's importance in that sector. And I highlighted South Korea as a good option. And I think that still kind of stands. China are still somewhat aggressive within that region. I know the Philippines are Philippines, Japan, South Korea are all kind of a bit on edge with what's going on over there. But really, all of these situations, all we can fundamentally do is try and monitor them and work our best to avoid having too much exposure to any of them. So yeah, that's something else that something else that I have to consider at the moment. It's a difficult time geopolitically, I would say, as an investor. Um, and then, of course, lastly, at the top, I don't know why I've done this in reverse order, but at the top we have interest rate cuts again. Still proving elusive, as I've written there. I think, as I said, it looks to me like the US is probably going to move first, and then I think maybe the UK would follow. Realistically, I think we're looking at 2025 before we start seeing interest rates coming down towards the kind of sub 4% maybe level. I expect that we may only have 2 or possibly 3 cuts this year, maybe even just one. So it's going to be still a bit of an uphill battle. That's going to impact our positions in things like solar and some of the other capital-intensive industries that I've mentioned, or products that people would usually use finance to be purchasing. So there's still quite a lot of room in front of us for things to improve there. As it does, that should of course benefit our portfolio quite dramatically, because fundamentally, if you're a growth investor, then you like a low interest rate environment. If you are a value investor, then that doesn't really matter quite so much to you, because you're not really reliant on debt to be growing the businesses that you're investing in. So that's the situation in terms of the future. That's where I think things are going. I feel like I've gone through this slightly faster than normal. No, maybe not. But yeah, that kind of does it for that part of the presentation. If you do have questions in the chat, feel free to throw them in. I'll start answering them in a moment. Before I do that, I just want to warn everyone to please be aware of scammers and people impersonating me across social media. I see it a lot on Discord at the moment, actually. There's been fake profiles of me on Instagram a lot in the past, on Twitter as well. At the moment, it doesn't seem to be too bad on those platforms, and I would say Discord is probably the worst area for it. So make sure that you're vigilant there. I would never approach any of my copiers individually, or anyone who isn't copying me individually, and try and give them financial advice. The only place that I do investing that can be followed is on eToro, and that is not going to change anytime soon. So yeah, please just keep that in mind when you're out and about on the internet. Okay, I will take a quick look through some of the questions that have been posted. What game did I play and what was my nickname? So asking about my esports background. I used to play StarCraft Brood War a very long time ago now. I ran the UK national team on that game for quite some time. After that, I moved into Command & Conquer 3, another strategy game, and then into Trackmania, and a little bit of StarCraft 2 for a small amount of time as well. But I didn't really make much money on that because I wasn't very good by then. But yeah, Trackmania is the place that I'm probably most known. My name was either Nemesis or Jaynemesis, as you see here. So that's where my name on eToro comes from. That was just my nickname playing games. So. Now you all know how to find me on Steam, I suppose. But yeah, those are the games that I used to play. Do you plan on getting into crypto this cycle? If so, which ones do you like? Not really. I mean, I think to some extent I'm a bit late for this cycle now. I'm still not really expecting altcoins to do too much, so I'm not really looking at anything there. And I tend to try and avoid the meme coins. I think Ethereum is still something that I'm very bullish on overall. I still think it's got the most potential utility as a whole. Obviously, I like Solana and Matic and some of the other chains like Matic that are kind of operating on top of Ethereum in terms of scalability. There were some other tokens that I used to like. I mean, I haven't really delved into things like Fetch AI and those sort of protocols yet. I think generally I tend to look more at traditional markets for investments in those kind of fields at the moment. So realistically, I think if I were to start building exposure again, it would be to mostly cryptos that are in the top 10 or so. I do still, outside of eToro, have some exposure to some much smaller cryptos. Most of which have done quite poorly over the past few years, but I still have some exposure to a few others. But on eToro, yeah, I think really it's only going to be the top 10 or so that I would consider investing in. Although they did add some more recently. I haven't checked what they added, but I think they've got 100 cryptos available on eToro to trade now. So there's quite a good selection. Thanks for your work. What do you think about TSM? Is it a risky investment? That's a good question, actually. I think when you look at it, TSM. So TSM was actually a company that I requested eToro to add 7 years ago or something like that, 7 or 8 years ago. Similar kind of time to when I was investing in AMD. And I think that really was their boom phase. That was their big growth phase. I'm not sure how much more growth they have, and if that growth is necessarily worth the risk of having exposure to a company that is so at risk from the China threat. Especially after what happened in Ukraine, I think realistically, most people, when they were looking at that situation, never thought it would turn into what it is. And the same is probably true for what's going on in a lot of the Middle East regions at the moment. I think a lot of people kind of dismissed the concerns that people had there about tensions boiling over. But as a result of that, I'm kind of keen not to avoid, keen to avoid that potential mistake with China. Especially since their economy is a bit more flaky at the moment as well. So there's always the chance that to kind of win public support, they try something a bit silly. So yeah, I'm not sure that TSM is really the way to go. I think actually one of the companies that I think is still interesting, and I wrote a post about them 2 years ago or so, I think, is ARM. So ARM have a completely different kind of architecture for their chips. It's very, very different to the way that the chips that TSM, for example, or Samsung produce work. And I think what's telling about the potential that they have is, firstly, the switchover that Apple did when they moved from Intel to using ARM-based CPUs. That was quite telling, and the performance uptick that we saw as a result of that in their products was really interesting. And then I think the second thing, and probably the more important thing, is looking at NVIDIA, who everyone is obviously kind of looking at as the big dog at the moment in the semiconductor industry. They attempted to acquire ARM not too long ago. And so if they can see value in ARM at prices that are higher than they were now, I'm pretty sure. I'm not sure. I'm not too sure actually. I need to double check that. But if they can see value in ARM at those prices, then I think that's quite telling on how valuable that company is. And of course, they only went public again quite recently. So that's one that I think is kind of interested in to look at in the semiconductor space. Aside from that, I would say probably diversification is your best bet, really. Whether you're investing in some of the companies that make the manufacturing equipment that are based in Europe and the Netherlands, or if you're looking at companies like AMD and NVIDIA that do the chip design, or Samsung even, and kind of taking a slightly more of an outside bet on South Korea, then I think all of those are kind of valid options. But I would say that given the state of that market and also the hype surrounding it, probably having a more diversified approach is actually the better option at the moment. But it depends on your level of knowledge on the area. Sorry, that was a very long-winded answer for yeah, it is still risky. Thanks, Jay. So overall, where do you see your solar positions going at the end of 2024? So I think realistically, I think for Enphase, we're maybe looking towards getting back towards kind of break even, back towards just below where their stock topped out. Again, this depends on how quickly interest rates come in. I think the fact that they're a little bit slower is means that it's going to take a little bit longer. But realistically, they're still in a really strong position in terms of that market. The same is true of SolarEdge. SolarEdge have performed definitely much worse than Enphase have. I think Enphase, it's quite clear that they're pretty much at the bottom now of their kind of their correction, and it really should only be upwards from here. I think SolarEdge may still have another couple of weaker quarters. But again, I think when you're looking at the solar industry, looking at panels or even installers is much more risky than looking at these two inverter companies, which is why that's where my money is. I know that Canadian Solar and some of the other companies like that have done slightly better, but overall, I would say when you look at all of the different panel manufacturers, they're just a lot more volatile and a lot more risky, I think, especially with some of the developments that are actually going on in the actual panel side of the solar industry at the moment as well. There's quite a lot of innovation going on right now that could disrupt the actual panels businesses quite a bit, depending on who wins out in the R&D of that kind of area. And likewise, the R&D, the expense of the R&D in that area is substantial as well. So that's having a big impact on margins for those businesses, I think, or certainly will do. Whereas I think realistically, we're apart if you're excluding the kind of string inverters that you can get from pretty much anyone. I think SolarEdge and Enphase are still in a really good position, and I think rooftop solar and residential solar is still likely to continue growing for some time. So yeah, I'm still bullish on both those companies. And I should stress that, again, I wrote a post about this a while ago that you can probably find on my eToro feed if you scroll back a bit. The long-term prospects for both Enphase and SolarEdge are really compelling arguments, I think, which is that they're trying to get into the energy management business really, and set up these virtual power plants and then sell energy back to grids around the world by kind of combining all of these different residential or relatively small, like micro generation plants, if you want to call them that, into one big kind of virtual setup that can then help serve the grid and help shift and load balances around the grid. And they will get paid pretty well for that when the time comes for it. So great work and thoughts on lithium as a commodity to invest in, or companies involved with recycling batteries. We're pretty close to the bottom in terms of price. Okay, yeah, this is an interesting one because honestly, the company I like most in terms of the batteries and especially the recycling side of things would be, I'm trying to remember their name now. I can't remember their name, but they're private. They're privately held. I don't know what the name is at the moment, but I'll post it in on Twitter or something afterwards. I'll go and Google it and find out what it is for you. So if you want to know what it is, you can follow me on Twitter and I'll post about it there. But they're invested in by quite a few different big funds that you can get exposure to through stock markets. Obviously, you're going to be very heavily diluted because they're investing in lots of things. But I think that's the one company that I'm most bullish on in that space. In terms of the kind of theme around lithium overall, I think when you look at what's going on with the demand for electric vehicles, which is by far the biggest kind of consumer of that commodity, I think we've still got some road ahead of us before things start to improve there in terms of demand. And so I'm not sure that lithium is the route I would go. I would say that copper is much more compelling. And again, that's why, as I mentioned earlier, I have exposure to a copper mining company. when you look at the utility of copper in comparison, and the in terms of more kind of the general infrastructure around electric vehicles and around electrification more broadly, I think it's just a slightly more compelling argument at the moment. So copper, I think, is still even now slightly better option than lithium. And yeah, I'll post on Twitter the name of that company if you want to do some research on it. What do you think about gold as a hedge? It had quite a run lately. Is it an indicator that the market is about to turn? I don't think it is, actually. I think there's been a lot of kind of fear that the AI hype is too substantial and that that's going to bring markets crashing back down. I think some of that is justified. Even just today, with Meta's earnings, the amount that they're trying to spend on their AI is concerning a lot of investors, very similar to what they did kind of chasing the trend of what was it called, the kind of NFT worlds and everything that they were working on before, which I can't remember the name. Metaverse, there we go. I think again, like, there are some companies like that tend to be kind of following the trend and not leading it. And I think when you look in AI, there's a lot of companies doing this that are using it as a buzzword and are claiming that they've developed cool AI things, and when in reality they haven't. I think it's true for a lot of these kind of areas of technology. I think when you look at self-driving cars, fundamentally, I think that's now looking like it's going to be at least a decade away. What's going on with Tesla there, self-driving cars and robo-taxis should not be part of the valuation of that company, in my opinion. And it's similar with AI. Apple are very, very far behind on AI by the looks of it, to the point where they're essentially almost giving up. Google, I think, have struggled dramatically as well. Really, you've got to look at who's actually got products out there now that are being used. And you found no picture of my dreads here. Yeah, how those kind of companies are actually using AI to actually generate revenue at the end of the day, because I think there's a lot of companies out there that aren't. So yeah, another thing to kind of keep in mind when you're looking at AI companies to invest in. Okay, I'm going to give it another 5 minutes, maybe a couple of minutes. See if any more questions come in, and if not, I will call it a day because my voice is starting to go, and the markets need me. There's lots of earnings today, so I would like to monitor it. Okay, looks like no more questions. So thanks for joining and tuning in and asking your questions. Some great questions today, actually. Really enjoyed it. If you missed any of this and you want to catch it again, you can, of course, do that on YouTube. If you are not following me yet, then you can do so at the social media links given here. Realistically, Twitter is the only place that I'm really that active these days. And of course on eToro, where I'm always writing more content, and you can see all my trades and everything going on there. One final thing that I will mention is that I'm going to be making a deposit onto eToro soon, to make sure that I'm still comfortably ahead of their minimum equity requirements that they changed recently, so that it shouldn't impact you in any way, really. But if you want to understand it and understand what I'm doing with it, I have made a post on eToro about that a couple of days ago, which covers what's happening and when. But realistically, it won't make any impact to any of you. You can decide to either add some additional funds to the copy yourself or not, and either way, eToro's new kind of algorithm will make sure that your portfolio is synchronized with mine. So that's it for this call. Thank you, everyone, and I will see you guys in the next one. Bye.